Thanks for clicking. Canada's 2025 budget puts the country at risk of a credit downgrade. This according to a new warning coming from Fitch Credit Ratings agency. Yeah, according to Fitch, the recently released budget with a deficit nearly double what was forecasted last year could weigh on the strength of Canada's credit rating, which, as we'll see today, could in fact push up fixed mortgage rates. Yet, as we'll see today, the headlines aren't exactly capturing the full story, as it's the events coming out of the United States relatively more than that of our own credit rating, which will dictate Canadians' cost of borrowing.
Oh, that's not good.
So what I want to do today is go over the warning coming from Fitch, take a look at what previous credit downgrades have done to countries' cost of borrowing, and then discuss why it'll be the United States, as it always is, that dictates how much Canadians pay for their fixed-rate mortgages. One thing that will help to keep Canadians' cost of borrowing in check is our inflation data, which is set to be released in a week from now. We'll obviously have an update out on that data on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, let's get into this potential downgrade. On to Canada's potential credit downgrade. In the wake of the $78 billion budget deficit announced last week, Fitch is warning that persistent fiscal expansion and a rising debt burden have weakened Canada's credit profile and could increase rating pressure over the medium term. And it makes sense. Canada is set to borrow relatively more than our peers with a similar AA credit rating, with the deficit set to come in at 3.3% of GDP, higher than the median of 2.3% for Canada's peers, and way higher than the pre-pandemic 0.4%.
For a little while. Only for a little while.
And yeah, just like you and I, when we don't act responsible, when we spend beyond our means, there is a consequence when we go to borrow money. The banks charge us a higher interest rate. And it's not just the yearly deficits that are the problem, says Fitch. It's also the overall debt to GDP burden, with debt to GDP set to hit 91.8 in 25, all the way up to 98.5 by 27, again, nearly double that of other countries with similar AA ratings. Now, on a quick note, this 92% debt to GDP ratio may come as a surprise for those who looked in the budget, which tells us that Canada's net debt to GDP is sitting at 13.3%, the best in the G7. But as National Bank pointed out last May, when Canada calculates its net debt to GDP ratio, it includes all of its CPP and QPP assets, minuses that out of the debt, which gets it a lower debt to GDP. With that said, does any bond investor really believe that an elected politician is going to touch CPP or QPP if the you-know-what hits the fan? I don't think so.
You saw that, huh?
Further, Fitch is also noting that the government deficit, the government's finances, are probably worse than the government is letting on, noting that the Canadian government has a history of upward deficit revisions, breaching all of 2024's budget guideposts. So, Canada's budget, not great in terms of spending, credit rating at risk, probably worse than the government's letting on. But so what? What's this all mean for the cost of borrowing? First off, because it's always worth noting and passing on to your realtor, broker, and bank rep, the Bank of Canada does not set Canada's cost of borrowing. That's set by the Canadian bond market. And the way that we know that is that when the Bank of Canada cut interest rates by 25 basis points on October 28th, the yield on the 5-year Government of Canada bond started off the day at 2.62% and ended off the day at 2.74%, which worked to push up fixed mortgage rates. The yield on a Government of Canada bond is the profit earned from that bond, and if the Government of Canada is going to pay more to borrow money, that means that you and I, which are for now seen as riskier borrowers than the Government of Canada, will pay more to borrow money as well. So the central bank cut interest rates by 0.25%, the bond market went the other way, and mortgage rates increased. Please pass it on.
Right. Kick ass.
Now, as to how this potential credit downgrade could affect Canada's cost of borrowing, the data is a bit mixed. A 2021 study from Torrens University of Australia looked at downgrades of OECD countries between 2000 and 2020, found that for those countries with debts denominated in their own currencies, a credit downgrade didn't carry with it a statistically significant effect on bond yields, meaning we saw credit downgrades and bond yields, and thus mortgage rates, didn't really change.
And we're home free.
And there is some evidence to back that up. Canada saw a credit downgrade in 2020, and yields didn't really do anything. In fact, yields were down the following month. But then we get into the post-2020, post-COVID era, and bond investors, for good reason, are a little bit more nervous. When France saw its credit downgraded as of recent by Fitch, it did see an increase in its borrowing costs, up about 10 basis points immediately following the downgrade. And the US saw something similar when it was downgraded on May 16th of this year, with the yield on its 10-year bond rising by about 12 basis points in the immediate aftermath of the downgrade. And here's the interesting part, Canada's own bond yields also rose in the aftermath of the US downgrade, which makes sense. Canadian and US yields have run an almost near tandem, which really tells us what we need to know. The yield on the 5-year Government of Canada bond barely moved on the warning from Fitch. In fact, they fell the day the warning was issued. They also fell about 3 basis points when the budget came out, as investors were happy it only came in at $80 billion. Yet they moved far more on the US downgrade back in May. Those yields also rose over 10 basis points in late October, following the yield on the 10-year Treasury, on comments from the Bank of Canada, and then rose relatively more after comments from the US Fed. Pulling this all together, that means that yes, a downgrade from Fitch would be problematic, would push up borrowing costs, but also B, Canada could see just as big of a swing in its cost of borrowing stemming from a US downgrade, or even just stemming from comments coming from the US Central Bank. Now look, all of this isn't to say that Canada's credit rating isn't important. It's not to say that Carney won't be the downfall of the country. And it's also not to say he won't be the long-awaited savior of the country.
How dare you?
But what it is to say is that events occurring south of the border will have a much greater impact on our cost of borrowing than anything that happens here domestically. And south of the border has been flying blind for at least the past month. When this government shutdown finally does end, it looks like that could be imminent, we could very well find out that the US is in a stagflationary spiral. Low growth, a worsening economy combined with high prices. Or the US Supreme Court could rule against the legality of the tariffs, though I find that highly unlikely. Trump very much has the court. Regardless though, a stagflationary spiral or a reversal from the Supreme Court could, and probably would, result in spiking US Treasury yields as Trump has to go to the bond market to pay back all of that tax money. So, while yes, the warning from Fitch is definitely consequential, the data from France and the United States tell us that a downgrade will be met by an increase in our cost of borrowing. The real driver of Canada's fixed cost of borrowing remains the United States. Whatever happens south of the border, not at all just with the tariffs, but coming from the Federal Reserve and coming from US structural deficits, long-term debt problems, will have a much greater impact than a simple downgrade north of the border. As such, while yes, domestic factors are important, if you want to understand where Canadian borrowing costs are heading, we have to continue to look at the United States, as it has a much bigger impact on our own market than our own market does. With that said, we will obviously continue to track how these dynamics play out. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.